Hello, my YouTube friends, and happy Friday. Hope everybody's doing awesome. So, today I'm going to talk about what I'm going to call the dividend myth. It's not really a myth, but I'll explain that throughout the video, and should be a really good video today. So, stick around. I'm hoping it's fun.
Want to make your money work harder? Enjoy another video with Adam Kahn, the rational investor on stocks, real estate, and crypto. Subscribe now for your weekly dose of investment insights and hopefully learn a thing or two.
Now, you tell me, would you rather a stock that doubles in value or one that pays a 4 or 5% dividend? That's what I'm referring to when I talk about a dividend myth. What I really look for when I make an investment is what I'll call total return. And so do some other people. So I don't want to say that's what I call it. That's what most people call it. And the only thing that at least I want to focus on is total return and try to do the best of total return that I can in my portfolio. Now, keep in mind, as always, my little disclaimer, this is by far not financial advice. I'm just showing what works for me and discussing the things I like to do. You guys really need to reach out to your own financial advisor and figure out what works for you. Because part of why I mention this, and this is in all sincerity, is everybody needs to invest for what fits them. Meaning, the advice for me may be good for me and not good advice for you. It's going to be dependent on age, risk tolerance, like what you want out of your portfolio. If you're meeting with a good financial advisor, their first question should be something along the lines of like, what's your goal with the investment? Is it money that you're going to the casino with that you're willing to risk and take a big gamble on? Or is it something you really need for retirement, or where are you in your lifespan, and then determine what to do with each portion of the money. So when I talk about the things in my videos, I'm just talking about what's going through my mind today on the things I'm looking at as somebody who's 52 years old, about to be 53, who's in a position of where I'm looking towards retirement, and maybe there's a little bit more of needing to have some security in the investments. Sometimes that may actually not be the best investment, meaning I might be better off somewhere else in terms of growth and growing the portfolio. But by protecting it fits what I need for my portfolio. So when I talk about the dividend myth, I worry that a lot of people, when I watch the videos who are young, are getting into really boring old stocks that aren't really going to help them outperform the markets and put them in a position when they get older to actually start going into those stocks. I watch some pretty young guys on YouTube buying some of the most boring, not going to grow, pays a dividend. Like, I get it. I think they're good companies and I see nothing wrong with it. But in my mind, at that age in their life, if they have a secure income, really they should be looking for some more growth in the portfolio to get ahead on things. Now, that's just my opinion. You guys, of course, can have your opinion. But people get really over saturated or over into the dividends and the payments and things of that nature. Where it really matters is the company growing? Are they overextending? Are they borrowing too much? Are their earnings good? My God, do they have enough to make the payments on those dividends? I look at some of these yield max funds that I've done some videos on that I really can't stand. Because what ends up happening is they're using the money in the portfolio to make these massive distributions, and the value of the stocks are dropping. And a lot of the sales pitch on these is often to people going into retirement where they may need the income. I mean, the guy who runs the fund says such awful stuff that contradicts it stuff. It drives me up the wall. And quite honestly, I think he should be held accountable for some of it. He talks about, the people who should be investing in these funds are the ones who need the income from the distributions. And then he follows up with, but the real way to maximize your gains is to reinvest your dividends. Well, which is it? Jay, forgive me, but is it that you should be reinvesting those dividends, or is it for people who need those dividends to be able to pay bills? Because it sure doesn't seem that way. Because even though the dividend payout, when you look it up, looks like a high percentage, that's partially because a lot of the stocks have dropped in value and they were paying out a bigger percentage in today, like at the lower value, because the stock was priced higher when you invested in it. So if you buy a stock for $80 that's paying a 10-cent dividend every month and the stock drops to 40 and it still pays 10 cents as a percentage, that looks like it's paying better, but the stock fell in half. So who cares that it's better? Anyway, that's going off on a tangent on the yield max stuff. It's just an example of not being too attracted to the dividend payments, sticking with good companies that you think are going to grow over time, and focusing on your total return as opposed to how much a stock can pay out. Now, as you get older, I recognize that dividends might be a nice way not to pay attention to the market and worry about when to sell some shares if you actually need some money to pay some bills. If total return is your goal, but you don't want to worry about is the stock that I own higher or lower when I actually need to start relying on some of this money, that's when I see a good time to rotate into things that pay dividends. But you still want to pay attention to make sure that the companies can actually pay those dividends, which is going to bring me to two stocks that got crushed yesterday, I think. UPS and Whirlpool. I see one as a really good opportunity to buy some of the shares, and I see the other as a bit of a risk. So UPS came out with earnings and reported that they're going to lose their largest customer by 50% of the business they do with them. Now, we can all assume that this is Amazon. My concern with UPS and why I don't see it as being a good opportunity is they're already pressing the limits in how much of a percentage of their cash flow they're giving out in their dividend. So if they want to maintain that dividend and they're about to lose half of their bit largest customer, and I forget the percentage that they said they do of their business, but it was a large percentage of their revenue. It's going to be really hard to maintain that dividend, and they may have to start taking on debt or do something they shouldn't be doing to just try to force to continue to pay that dividend so it doesn't look bad in the investment world. And I think that could be a big mistake. And if they end up cutting the dividend, which is what a lot of people are attracted to in a company like UPS, well, that could hurt the stock even further. So I see some headwinds in their way, and I see some concerns that I just don't see it as a great investment right now. I thought it was better actually before these last earnings, but my real concern is losing half of Amazon's business. Outside of that, I thought they were cutting staff, they were doing some good things, and maybe we could see a turnaround, but this report really bothers me. Now, Whirlpool, on the other hand, who has been struggling for a while, so the stock price deteriorating, it has good reason. At the same time, what I like about Whirlpool is I think that's just a matter of time. I don't really see people not buying dishwashers and washers and dryers or whatever products that Whirlpool makes. I'm guessing that too many people bought a ton of it when COVID was going on, drove the stock too high, and now things are slowing because it's not COVID anymore and people aren't remodeling quite the same. And if a lot of people just recently bought new products for their homes, there's probably not huge demand. It's probably less than it used to be, which is why we're seeing the slower sales. Sounds pretty bad, right? Well, yeah, in some ways, but I figure in time that'll work itself out. It'll normalize again, and they'll have the right amount of sales for the right amount of homes, and things will make more sense, and they'll be able to continue to grow from wherever that bottom comes in. But what I do like, and the reason I say that after all of that stuff that didn't sound so great, is they're not really in jeopardy of needing to cut the dividend. I think if I remember correctly, because I didn't look today, it was a few weeks ago before the earnings, I think they're using less than 50% of their cash flow to be able to make their dividend payments. And right now, Whirlpool is paying over 6% as a dividend. So, as much as the video was about don't fall for the dividend myth, as you get older, even me, I like dividend companies. And if Whirlpool can continue to pay that dividend, I'm perfectly content taking a 6% return on today's dollar value and then hoping that the company can turn things around over the next year or two. They've already prepared all of us for a rough year next year. So if it's a little bit better than they've prepared everybody, it could end up really well for the stock price. And if not, at least from what I would be investing in Whirlpool for, as long as they can continue to pay that dividend, I wouldn't be too sensitive to the stock valuation. In fact, if it goes lower, maybe I pick up a little more. I do worry, and this is just a little caveat. I try not to invest too heavily in stocks that are going through rough times. I will try to add on as they start doing better and I feel more comfortable with it. Like, it's just the way I try to look at them. and I wouldn't want to put in too much because God forbid it got worse and the stock really cratered and then did have to cut the dividend. I've seen enough over the years that nothing really is a guarantee, that it makes me be cautious either way. So that's my video on the dividend myths. If you haven't already, do me a favor and hit that subscribe button, smash that like button, make some comments in the comment section. I really appreciate that. You can't imagine how much that helps YouTube's algorithm and helps the channel. It's really more than you know. I'm not going to sell any products or push this or push that. I am tempted to write a book, but I don't think I'd really follow through with it. I apologize for not doing the videos on Saturday anymore. We signed my son up for snowboarding lessons on Saturdays, so he goes every week, and I take him out to the mountain. I kind of sit around, I watch my YouTube and hang out and have hot cocoa while he goes and does his snowboarding lessons, and we get to spend a little time with each other. And that stuff's really valuable to me. So anyway, I hope everybody had a great week. We had some pretty volatile markets, but it's been pretty cool. The market by the end of the weeks, I think it was selling off before I started to do the video, but for the most part, by the end of the weeks, the markets are doing well. And, for those of you paying attention to the trading account I told you about, I mean, my God, Amazon, Meta, um, Boeing, Google's over 200 today. It's crushing it, and securely. I think I saw it at $205 a share. And then Uber and recently Nvidia, like the market's doing really well, and I'm watching this trading account grow nicely. And then, as I've talked about in another video, I start playing around with MicroStrategies a bit. As much as all the gloom and doomers are out there talking about how the economy is going to crash, too much debt, inflation, and all the things that we're all well aware of, it seems like the market's chugging along just fine. So I hope that continues. Anyway, have a great weekend. If I don't talk to you, we'll see if I have time to do a video on Saturday, and have a great week next week.